Hello everyone, and welcome back to Explain the Charts. Today is November 7th, 2025, and we are diving into a comprehensive analysis of the QQQ, the ETF that tracks the Nasdaq 100. The market experienced a significant shock yesterday, and we need to unpack both the news driving the sentiment and what the charts are telling us about what could happen next. First, let's cover the news, as it provides crucial context for the price action we're seeing. Yesterday, November 6th, saw a major sell-off across the board, with the Nasdaq falling a steep 1.9%. Multiple reports point to several factors fueling this downturn. Investors are growing increasingly anxious about lofty tech valuations, especially after the massive run-up we've seen this year. Compounding this are troubling signs from the labor market. Due to the ongoing government shutdown, we're relying on private data, which is painting a concerning picture. One report from Challenger, Gray and Christmas showed that layoff announcements in October soared by a staggering 183% from the previous month. This has led many to believe the labor market is cooling much faster than anticipated, sparking fears of a potential recession. Adding to the bearish sentiment, some analysts, like Sean Pecci of Ranmore Fund Management, are warning that the market is dangerously overvalued, drawing parallels to Japan's 1980s bubble. He specifically points to the AI hype and the dominance of U.S. tech as signs of euphoria. However, it's not all doom and gloom. Other analysts believe concerns of an AI implosion are overblown, citing the long-term strength and earnings of the sector's leaders. Now, let's switch over to the charts to see how this dramatic news has been reflected in the price of QQQ. Here on the daily chart, we can see the broader story of 2025. The market has been in a powerful uptrend for most of the year, culminating in an all-time high just last week, up around the $637 level. But what's happened since is a very sharp and aggressive reversal. Yesterday's candle is particularly telling. It's a large, bearish red candle that closed down 1.63% on extremely high volume. This candle sliced through the support that had been holding for the past week, signaling a significant shift in market structure and sentiment. This is the market directly pricing in those fears about valuations and the labor market that we just discussed. With this breakdown, we must now identify the new key levels to watch. The most immediate support is yesterday's low, right around $610.30. If that level fails to hold, the next major area of interest is the support zone established during the October sell-off, which sits between $590 and $600. Below that, the next critical support would be the lows from September, down around the $560 to $565 range. On the upside, the area we just broke down from, between $620 and $625, will now act as the first major resistance level. Any attempt to rally will likely face heavy selling pressure there. The ultimate resistance, of course, remains the recent all-time high near $637. Let's zoom in on the daily chart to get a better look at this recent topping formation. I'm filtering from the start of October to see this price action more clearly. You can see the market accelerated aggressively from $600 to nearly $640 in just a few weeks, which often happens before a significant peak. Following that peak, we've now established a series of lower highs and lower lows this past week, which is the technical definition of a new downtrend. The breakdown yesterday was the confirmation of this reversal pattern. Now, let's drill down to the 1-hour chart to analyze the breakdown in more detail. This time frame gives us a much clearer picture of yesterday's aggressive selling. We can see a gap down at the open, from Wednesday's close around $623 to Thursday's open near $621. This gap area will now be a formidable resistance zone for any potential bounces. Throughout the day yesterday, we saw consecutive bearish candles on high volume, indicating relentless selling pressure with very little fight from the bulls. The price cascaded downwards, breaking through several minor intraday support levels without pausing. For a short-term bullish case to emerge, we would need to see the price establish a solid base above yesterday's low of $610. From there, bulls would need to push the price back up to challenge that gap, starting around $621. However, the more likely scenario, based on this chart, is that any small bounce will be sold into. If we see the price break below $610 with conviction on the hourly chart, it would signal the next leg down is beginning. Finally, for the day traders, let's look at the 15-minute chart. This shows the minute-by-minute story of yesterday's collapse. The sell-off intensified dramatically in the afternoon session, finding a temporary bottom right around 3 p.m. at the $610.30 level. After that low was made, there was an attempt to bounce, but it was weak and failed to reclaim any significant levels. The market then consolidated into the close, finishing the day near its lows, which is a bearish sign for the following session. As we head into today's market open, the key battleground will be that $610.30 low from yesterday. If we see a strong defense of this level at the open, we might get a relief bounce toward intraday resistance at $615. Conversely, an open below $610 followed by continued selling on the 15-minute chart would be a strong confirmation to the bears and could trigger another wave of selling. All right, let's switch back to the daily chart to recap and discuss our outlook. The situation is tense, with a clear conflict between the long-term uptrend and this new, aggressive short-term downtrend fueled by negative news. Let's summarize the critical price levels one more time. Major resistance is the all-time high near $637. The first key resistance to watch for any bounce is the $620 to $625 zone. Our immediate pivot point is yesterday's low of $610.30. Below that, the first major support target for bears is the $590 to $600 area from the October lows. If that fails, the market could be looking at a much deeper correction towards the $560 to $565 support from September. So, what are the potential scenarios? Our primary scenario, with about a 65% probability, is that we see further downside in the short term. The combination of a technical breakdown on high volume and a fundamental catalyst from the labor market news suggests sellers are currently in control. Under this scenario, we would expect a test of the $590 to $600 zone in the coming days or weeks. This bearish view would be reinforced if the price fails to reclaim $620 on any bounce attempts. An alternative scenario, with a 35% probability, is that this was a panic-driven flush-out and buyers will step in to defend the long-term uptrend. For this bullish case to play out, we need to see strong, decisive buying pressure at the $610 level. A powerful reclaim of the $620 level would be a very strong bullish signal, potentially trapping shorts and fueling a rally back towards the highs. Things to watch for going forward will be any new data on the labor market and inflation, as well as any commentary from the Federal Reserve that could influence the odds of a rate cut in December. Finally, it's crucial to remember that this video is for educational and informational purposes only. It is not financial advice. The stock market is inherently risky, and you should always do your own research and consult with a qualified financial advisor before making any investment decisions.